Hello, investor. It's Mike Chupka here, the Director of Options Education from Power Options and Radioactive Trading. And I'm here to discuss with you today is the married put approach, the proper protected structure right for you? Can you benefit from limited risk trading? What is a proper protected structure? Well, it's the correct setup of a married put position, a stock plus put combination that takes advantage of the three core principles of options trading, any options investing strategy. The proper protected structure guarantees single digit risks on any position while leaving the upside open and gives you 12 ways to still generate income, lower the initial at risk, and potentially bulletproof your trades. Now, is this structure really better than any other common option strategy that you've been introduced to? Well, the most common option strategy is a covered call position. When you first apply to trade options, you're given level 1 trading and you can enter covered call positions. Well, the covered call consists of buying stock, selling a call option where you can use weekly options and generate potentially 0.5, 0.7, maybe even 1% per week on more volatile positions. And you can potentially see a return of 2 to 3% per month. But does it let your winners run? If the stock exceeds your expectations, moves up 5, 6, or 7%, do you see any more of that upside profit? No. You have a capped gain to the upside. What about protection in adverse market conditions? You have the subtle protection of the premium that you generated. Oh yes, you can use a stop order, but does the stop order really protect you from those sudden, unexpected movements where overnight the stock falls 10, 15, or 20%? No. The stop order is just a market order telling your broker to close you out of the position if the stock is below your target price. Meaning that if you set a 5% stop order and the stock falls 15% overnight, they can't give you the price of the 5% loss. You still take the 15 or the 20% loss on the position. This is a common misnomer for the covered call strategy. In fact, over the last several months, we've held over 13 webinars on rolling covered calls where the stock has moved up beyond their expectations to attempt to realize more of the upside gains, and webinars on managing covered calls to the downside where the stocks have gone beyond their stop orders and what can they do now to try to get back to break even. How about those popular strategies of leveraged spread trades, earning double-digit returns with using a limited risk on the position for the structure of the spread? Well, those positions give you a known risk, not a low risk. You can still lose up to 100% of what you invested in that position if the stock goes beyond your expected direction. And what success rate is needed when you're looking at a 7-to-1 or 8-to-1 risk-reward ratio to receive the profit that you want and the probability that you expect? Let's take a look and simulate some scenarios. We're going to head on over to radioactivetrading.com and take a look at the Trade Simulator tool. Now, as we walk through this tool, I want you to keep in mind the stock patterns from 2020. And I want you to keep in mind how your trades performed and your preferred strategy performed during 2020 and the wild swings that we experienced. Now here we are at radioactivetrading.com, and we're simply going to click on the Resources tab, and we're going to navigate down to the Trade Simulator tool. What this tool does is allow us to put in our expected target return for a given strategy, while controlling our losses whether it be a stop loss or the proper protected structure of a position. We can then input our probability of loss, our win-loss ratio. We're going to set a starting amount and our invested amount per trade. Let's take a common covered call structure. Let's say we go 1 month out in time. We buy a stock, we sell an at or just slightly in or out of the money covered call. What would we expect for a potential return? Well, we're going to see an average of about 3% return. We're going to control our losses using a stop order of about 7 to 8%. If the stock falls 7%, we're going to close out of the position. Now, as we know, a stop order of 7% is great, but if the stock falls overnight by more than that, we're going to take much higher losses because this is just a market order to tell us to get out of the stock if the stock falls below that 7% price. Now let's input that we're going to expect that we get a 70% success rate, meaning a 30% probability of loss. We start with $10,000 and we're going to allocate 50% of that $10,000 to each individual position. What can we expect to make? Over 100 trades. The simulation tool is going to flip a coin 100 times. Heads, we make 3%, our expected max profit. Tails, we only lose 7%, hopefully, if the stock falls down that amount. We're going to expect a 70%. Let's flip that coin 100 times, and what do we see? If we have a losing track record, and by losing track record, meaning we're only right 66% of the time, over an extended period of time, we're down essentially 20% of our portfolio. That's not a recipe to be successful long term. Here we are at a very successful track record. We're right 76% of the time. 76% of the time we make 3%, and only 24% of the time we lost 7%. At one point, we took our $10,000 over those 100 trades, and we had a high profit value of about 32%. And that was the end amount over 100 trades. But we were expecting to be right 70% of the time. This exceeded our expected goals. What happens if we're right just 70% of the time? Well, this will run a random simulation each time, and here's a good example. 71% success rate. We enter at the money or slightly in the money covered calls. We're expecting a 3% return max if assigned. We've controlled our losses to 7%, hopefully, with a stop order, which is just assumed insurance. And we're right 71% of the time. Well, at one point, we took our $10,000 and saw a high value of $12,396, roughly a 24% return. We have a low downside risk of about 10%, but at the end, over long-term trading, we're only up $242. Is this the recipe for successful wealth over time with a proper structure? No, I don't think that's meeting your goals. Let's take a look at those leveraged spread trades. If I enter a in-the-money bull call debit spread, an out-of-the-money bull put credit spread, an out-of-the-money bear call credit spread, I might expect a good return, double digits, of about 15%. Now, I know if the stock falls against me in a bull call or a bull put credit spread, or if the stock rises against me in a bear call credit spread, I'm going to try to close that position and control my leverage loss to only 50% of the maximum loss potential. Now, of course, we're going to shoot for a higher percentage return. We're going to try to be right 75% of the time with a probability of loss of only 25%. This means using a short option delta for a bull put credit spread of only about 0.25, or for a bear call credit spread on the outside and out of the money, a delta of 0.25. Looking for double-digit returns, attempting to control our losses, to minimize so we never see the 100% loss on the position, is this a recipe for success long term? Ooh, well, if I don't hit my targets at all, if I'm only right 66% of the time, that money that we set aside to enter these spread trades, we can end up bankrupt, losing all of it, depending on the win-loss ratio and the number of losses that appear in our first several trades. But we want to be right more often than wrong. So let's get to a success rate of 78%. Wow, that doesn't do it either. At one point, we think we have a very successful track record. We're up about 35% from where we started with our initial investment amount of $10,000. But at one point, we're down almost 90%. And long term, this is not a way to be successful long term. In fact, to get the returns that you expect to see with a leveraged credit spread position, you have to be right 85% of the time, and you can potentially see large potential gains against what you initially started with, and large potential gains long term, but you're going to have to deal with the whipsaw of large potential losses as well. Now let's take that covered call structure and reverse it with the proper protected structure. Instead of looking and targeting a 2-3% return because of our premium that we generated and capped the upside, let's leave the upside open and assume we get a 7% return. Well, at the same time, we know we're controlling our loss limit to 4, 5, or 6% on our investment. Now, let's assume that we don't have the potential probability that we'd have with a covered call, or even with a leveraged credit spread, and let's just assume that we're right 50% of the time. We take the same $10,000 allocation and 50% of that $10,000 into each position, and what might we expect to see? Well, that's fascinating, isn't it? With only a 53% win ratio, we could potentially see our $10,000 over 100 trades grow to $25,000. A max drawdown, even with 5 or 6 losses in a row to start the trading technique, is down only 10 or 12%. And after 100 trades, a year or so of trading, we're almost double what we started out with. Well, let's get this closer to 50-50 and see what we have with the simulation. Here's one where we're just right 52% of the time. A max drawdown of only 6%, and at one point, we have a high value with that trading record that's more than double of what we initially started with, and the ending amount after 100 trades over several iterations of trading. We're well beyond the initial starting point and well beyond meeting our potential goals. So that simple tool at radioactivetrading.com just showed us that the proper protected structure puts the market odds in our favor. With a controlled risk in the proper structure and leaving the upside open, we can be right only 50% of the time and outperform other strategies that need a 70, 75, 80% success rate or more. This is the proper structure for investors to grow their portfolio long term, rather than attempting to look for that next big thing that hits the home run and gives them the promise of double digit or maybe even triple digit returns that only works in certain markets but doesn't work long term in your portfolio. What exactly is the proper protected structure? Well, it's a married put position, as we mentioned earlier. A stock position plus a proper structured put option to guarantee single digit risks. If I was to open a married put position today on a stock such as Sleep Number, I might buy 100 shares of stock at 86.08. And at the same time, I might buy a far out in time, in the money, 100 strike put. Now, this will increase my cost basis of the potential stock, but this guarantees me a strong exit on the position, unlike a stop order, which is assumed insurance. So even though I've added to the cost basis of this properly structured position, my total at risk is just about 8% on the position. I buy shares of stock at 86.08. I buy the proper structured in the money put far out in time. And my cost basis might be about 109.18. But I'm guaranteed to get 100 back no matter what the stock does. So the maximum risk on my structure is only $9.18 per share, or 8.4% on the total position. Earlier, I mentioned that the proper structure takes advantage of the three core principles for any options investment. What are these three core principles? Well, number one is FIST, forcing an ideal sized trade. You might look to buy calls on an underlying security that you expect to move up in price over the next 2, 3, or 4 months, or even the next 2, 3, or 4 weeks. But you're not going to invest 40% or 50% of your entire portfolio into that position. You're not going to put all your eggs into one basket. You might just trade 1 or 2 contracts, or 5 contracts, or 10. But you have to know that when you're buying a call, you're risking 100% of what you invest into that position. The proper structure that takes advantage of the three core principles forces us into an ideal size trade where we know we're only risking 4, 5, or 6% of the total monetary value we put into that trade. The second core principle is the at-the-money bell curve. It's a very simple thing, but if you look at any option chain in any expiration, the at-the-money options, those trading closest to the stock price, have the highest time value. Those that are in the money or out of the money have a much lower time value. What does that tell us? That tells us that when we're buying options, we want to be buying in the money or out of the money to lower the time value risk and the time value cost. But when we're selling, we want to sell at the money to maximize the time value in our portfolio. The third core principle is time decay, or the red line, the radioactive decay line. And what that shows us is that options that are 5, 6, or 7 months out in time have a much slower time decay in the first 30 to 60 days than an option that was only 30 to 60 days out in time, which decays much faster, which tells us that yes, we want to be selling closer in and buying further out in time in any options strategy. Let's take a deeper look at these three core principles. Forcing an ideal size trade. Well, we already showed the concept of potentially buying shares of Sleep Number at 86.08. And to get the proper structure and the proper controlled risk, we might buy a June 100 put far out in time for a price of about $22.85. Now this would increase our total cost to about $108.93. But we're guaranteed to get $100 back no matter what the stock does. So the maximum risk on this position is only $893 if we bought 100 shares in one contract, or 8.2%. The maximum potential profit is infinite. And that cost basis of 108.93, which you might consider to be the break even, is only true at June expiration. Only if I held the position all the way to June expiration, made no adjustments, accepted no dividends, then I would need the stock to be trading at that price. But because of the proper structure, we have a positive delta. So if the stock just moves up 1 or 2 points in the next 2 or 3 days, we're still seeing a profit 50 to 60% of what the stock grows, still being able to control the downside to just single-digit risks. The second layer of protection we discuss in the blueprint is that even though this position only risks $893 of the invested amount, that monetary risk will only represent 1 or 2% of my total portfolio value with a proper structure. Gives us controlled risk. It prevents over trading and falling into the lie of leverage, and is the proper structure. The second core principle that we should follow for any options investing is the at-the-money bell curve. The at-the-money bell curve shows us that the option that's closest to the stock price in any expiration series has the highest time value. This tells us that we want to buy on the outside wings to limit the cost of the time value purchase, and we want to sell at the money to get the highest time value when we're selling premium. Now, this not only applies to the initial structure of the proper protected structure trade, but also applies to all of the income methods that are used in the blueprint to maximize returns, generate income, and potentially bulletproof the trades. Now, over here on the right, we see just a basic graph. Looking at Sleep Number, the 85 strike option in any expiration series has the highest time value. The 70 strike call or put, whether it's in the money or out of the money, will have a lower time value. The 100 strike call or put will have also a lower time value compared to the 85 strike. But if the stock moves up, if I buy into lower time value for protection at the 100 strike, and the stock moves up in price, the 100 strike is now at the money, and that time value, the extrinsic value, will swell. Meanwhile, the in the money and out of the money options will have a lower time value. We can use this to our advantage to adjust the put option, that second asset that is not just wasting insurance. Over here on the left, we take a look at the max risk levels and the prices for the various put options on Sleep Number. Highlighted in red is the 100 strike put, which gives us a very controlled risk of only 8.5%. If I bought the at-the-money put option with a stock trading at 85.85, we bought the 85 put, the risk almost doubles to 14.9%, because the true risk on the proper protected structure is the time value. And the at-the-money option will always have the highest time value. We want to go in the money to control the risk to single digits. We don't want to go out of the money to pay the lower price, because now the stock has to fall to hit that price before the insurance kicks in. And instead of looking at a 7 or 8% potential loss, we're looking at a 21 24, 25% loss on the position. And that's what we need to avoid. The third principle of the radioactive trading concepts and any option concepts is the time decay curve, or what we sometimes call the red line. As we discussed, the time value is the risk on the position. If I buy an option that's 30 days out in time, I only have a short amount of time for the stock to move in my desired direction before I can see a profit, because the time decay is going to drop off rapidly. But if I buy an option, whether speculating for growth or to ensure my positions, that's 150, 160, 200 days out in time, in the first 30 to 60, 90 days, that time decay is going to be very slow. This also leads us to a point where when we buy options, we want to be buying further out in time, because the option that is 6 months out in time is not 6 times the cost of the near-term option. That means we get a lower annualized cost buying further out in time than attempting to set up a proper protected structure, buying options month by month by month. Over here on the right, we have a basic structure of married puts for MU, Micron Technology. We see here with the stock trading at 73.30, the January 80 strike put, only 30 days out in time, carries a risk of roughly about 2.1%. However, if we go out to April, 4 times the amount out in time, the risk is not 8.4%, the risk is only 6.3%. And if we go out to June, the 80 strike put, 6 times the amount out in time, from 30 days to 184, is not 6 times the risk or 6 times the time value. It's only 8% at risk, not 12% as we'd expect, 6 times the amount of time from the 30-day out option, which has a 2.1% risk. This gives us the idea that when we're selling, we want to be selling absolutely week by week or month by month to get a higher annualized return. But when you're buying, whether it's for insurance to properly protect your positions or even to speculate on increased growth or increased declines with long calls or long puts, you want to be buying further out in time to have a lower annualized cost. That is the definition of a proper protected structure. A setup that takes advantage of the 3 core principles of any options trade: forcing an ideal size trade to control risks to single digits, taking advantage of the at-the-money bell curve to ensure that you're paying the lowest amount of time value for insurance or speculation, and generating the most amount of time value when you're selling premium. And at the same time, rather than buying an option that's 30 days out in time and looks a little bit cheaper, it's better to buy farther out in time because you have a lower cost per day and a lower annualized cost for the position. So who can actually benefit from this approach of the proper protected structure and limited risk trading? Any investor who owns stock in their portfolios. Any investor who has core holdings in their portfolio where their purchase price is well below the current trading price and they have unrealized gains. And any investor who's looking to purchase shares of stock and benefit from the market upside without getting hurt by the wild, volatile swings we've seen in the last 3 years. Who else can benefit by this? Any investor who has been sold on the idea of covered calls, of attempting to earn 0.5, 1%, 2% per week or per month, but are not meeting their targets because the losses of the stocks fall are outpacing their expected gains. Who else can benefit from this? Any options investor who are not achieving their goals due to the lie of leverage on leverage spread trades, speculating on option buying and risking 100% on their positions, or any options investor trading leverage spread trades, not taking the proper approach, where again, just as the covered call, the losses are outpacing their gains. Now, I've mentioned this a couple times about the lie of leverage. What is this lie of leverage? Well, it's also referred to as the martingale or gambler's ruin. And what this refers to is that you go to Atlantic City, you go to Las Vegas, you go to any bettor, you do anything like that. If you take a 10% loss on your first bet, you don't need a 10% gain to get back to break even. You need 11% gain to get back to break even. And if you bet 20% on the roulette wheel and you lose it, well, you don't need a 20% gain on what you have left to get back to break even. You need a 25% gain. And if you bet a third of what you have on a certain spin of the wheel or on a blackjack deck and you lose that, well, you don't need a 33% gain to get back to break even on what you have left. You need a 50% gain. It is a slippery slope that hurts investors and absolutely hurts gamblers. But if you control your losses to single digits, if you enter the proper structured trade and only take a 5% loss on any trade that you enter, you only need a 5.2, 5.3% gain to get back to break even. This is the lie of leverage, where those investors looking to achieve maximum profits using leverage trades, speculating buying options, get hurt. Because once you take a certain amount of high percentage losses, which can and will happen with those strategies, you need a much higher gain on what you have left to get back to break even. But in the properly structured trade, if you take a single digit loss, you only need a single digit gain to get back to break even. If you're looking to protect your holdings that have unrealized gains, if you're looking to avoid the lie of leverage because those common option strategies have not given you the returns that you expected, if you're holding positions and you still want to generate income as you do with covered calls or potentially collar spreads or even cash secured naked puts, but have the benefit and security of limited risk, and you want to potentially be able to bulletproof your trades having no risk with still unlimited upside, then the married put and radioactive trading structure benefits you and is right for you. You can ensure core holdings that you currently have an unrealized gain on and leave the upside open. You can control risk on new positions that match your criteria for that new upside swing. You can potentially bulletproof existing positions that you have with that unrealized gain you're sitting on and wondering whether should I close, should I sell half, should I do anything. You can lock in most of those gains and still see unlimited upside profit. You can guarantee low risk on any new position and leave the upside open and still generate income to lower that initial at risk, increase profits, and potentially bulletproof your trades. And limiting risk is just the start. The blueprint teaches 12 different income methods. Why 12? Because they work in different market conditions. Some work best if the stock moves up as you expect. Some work best if the stock is stagnating. And some can even generate income, lower your cost basis, and increase profits if the stock falls against your expectations. These 12 income methods teach you to get income the proper way in the proper protected structure lower your risk even further, and potentially bulletproof your trades where you have no risk and unlimited upside. The blueprint, of course, is the full course on how to control risk, generate income, and bulletproof your trades. The various chapters go through how to begin a radioactive married put profit machine to control risk to no more than 4 to 6% of your capital in any position. How to properly use the different income methods to lower that initial at risk and potentially bulletproof the trade. Maximize your return using nested spread trades, where we can use credit spreads and ratio spreads in this proper structure without taking on the leverage risks that normally occur with those positions. There's a full chapter on combining the different income methods and several different appendices, including chart reading, income method decision table, and much, much more. And now, of course, is the best time for you to get access to the blueprint, the proper way to limit your risk in any position, and the proper way to apply the 12 different income methods. This is our special end of the year bonus offer for the blueprint. And if you purchase the blueprint before December 31st, 2020, you'll lock in these special bonuses. You'll be able to access the Fusion subscription at Radioactive Trading to follow our trades, search for basic positions, and increase lessons to help you master the techniques in the blueprint for only $10 per month. It's usually $69 per month, so you're going to save about $118 with your first 2 discounted months of Fusion. We're going to throw in one of our Mastery Series videos, The Foundations of Radioactive Trading, usually an $89 value. And we're also going to throw in the 5th CD, the 4 Insider Secrets of Trading, a collection of our 4 most popular webinars, usually a $29 value. That's yours for free. We're going to give you immediate access to the quick start guide, and you're going to get a free month of Power Options, the patented suite of search and analysis tools to find new positions, research and analyze those trades, and track and manage those positions in the portfolio where the rollout opportunities and the income methods are shown for you against your married put positions. You get instant access to the blueprint. It is now an all-electronic version. No shipping costs. We'll send you an email immediately with access to our educational site to access the electronic copy. Of course, you receive email support, phone support for free. Any blueprint owner can call us or email us at any time with any questions they have about the material, potential trades, or trades they are in. You'll also receive instant access to members-only content, blueprint owners-only webinars discussing the various income methods, in-depth discussion on trade selection, and much, much more. But remember, this special offer ends December 31st, so you want to act quickly to start properly protecting your positions and trading long-term with the proper protected structure. Now, if you have questions about limiting risk, and if the married put approach is right for you, send us an email at any time to support@radioactivetrading.com. You can also call us at any time at 302-992-7971. If you fall into one of those categories of how this limited risk trading technique can benefit your portfolio long term, make sure you pick up the blueprint before December 31st. Lock in those special bonuses for the end of year offer and start trading with limited risk and potentially bulletproofing your trades today. To get access to the blueprint, go to www.radioactivetrading.com/EOY and click the button for Access My Blueprint. Or just go to radioactivetrading.com and click on the Products tab.